on LinkedIn Live, which focused on regulatory and reporting trends, the tailwinds behind green finance, where we had speakers from HSBC, from a FinTech, Diginex, from GoImpact, and from the FinTech Association. Today's topic is carbon markets, a silver bullet for sustainability and net zero. In today's topic, we would be focusing on the development of carbon markets and its impact on sustainability and how it impacts corporates as they transition towards net zero. And we have very distinguished speakers today from the Hong Kong Exchange, Invest Hong Kong, GoImpact, and obviously ENY, whom we also want to thank for hosting us today. Andre?
Thank you very much for those who are coming here physically on site and also those online. And up and coming Hong Kong FinTech Associations, we will be having our physical booth at the Hong Kong Wan Chai Convention Center. So we welcome everyone to come on day one at 2 p.m. We have a group photos. So every year we have a booth, and then we are having more and more activities. And stay tuned on our Slack channel. We will have panel speaking and more expert sharing on top of the main conference event of Hong Kong FinTech Week. So stay tuned.
Yeah, I'll pass it on to Helene then start the discussion.
Yeah, I think it should be okay, right? Yeah. Thank you so much, Sandeep and Andre. Always a pleasure to work together with FinTech Association. And particularly today, I think we're in for a very special treat before the FinTech Week. We've got representatives from leading consultancy, EY, Eugène. We have got Chiu, that has the carbon and ESG at Hong Kong Exchange. And of course, Leung from Invest Hong Kong that looks after both FinTech and financial services. I think the diversity of the panel speaks for itself. And we love to, have your input also on some questions, observations. For those online, please type into the chat. And our moderators here will also field the questions to the podium for us. And for the people in the room, please feel free to, raise your hand and share your perspectives. Without further ado, I'd like to kick in with some macro observations of the voluntary carbon markets. Now, net zero is a big promise. To get there by the timeline that we said we will remains very challenging. And I think the carbon markets will be one of the tools, if you like, in the toolbox, particularly the growth of voluntary carbon markets, which is growing much faster than the compliance or regulatory carbon markets. The CAGR, the compound annual growth rate, is estimated to be about 14% between now, 2023, and 2028. So it's really significant growth. But there has been signs of slowing down this year, very obvious signs. And we've heard things about, are these, carbon credits really, fully third-party assured and all that. So I just want everybody's take in no particular order. Maybe I'll start with Eugène and Ken and King on what are your thoughts on this slowdown and what might be the premonition for the next steps to come in terms of the voluntary carbon markets. But before we go there, maybe just a quick one, Eugène, if I could trouble you, on voluntary carbon markets, compliance carbon markets, just to make sure that everybody has a quick glossary, if I could trouble the consultants.
In short, the key is in the word voluntary for voluntary carbon. There are two forms, compliance carbon markets and voluntary carbon markets. Compliance carbon markets are essentially government or regulatorily set up and mandated markets to set a cap on the level of emissions within a particular industry or a geography. So it might be the European Emissions Trading Scheme. It may be CORSIA, which is set up for international airlines. It then allocates carbon credits of a certain amount to participants in that industry or that geography. They can then, above a baseline where their carbon use exceeds a certain level, purchase those offsets from people whose carbon emissions fall below that level. So effectively, it's a way of reallocating a set amount of carbon emissions to the most efficient user of those carbon emissions, or the entity that puts the greatest value on the right to pollute up to a certain amount. Over time, the ceiling and the number of offsets issued gets reduced, hence trending towards a decarbonisation target. Compliance carbon markets are not set up by government. They're purely private sector initiatives at the moment, and they're purely voluntary. You are not mandated to participate. You choose yourself to participate. Anybody can participate in a voluntary carbon market. I can, if I wish to, purchase carbon offsets in a voluntary carbon market. But the main targets really are corporates, effectively, in some instances sovereigns, in some instances financial institutions. Now, what occurs is a project that could be anything from carbon capture and storage through to reforestation that has a certain impact upon carbon, either carbon avoidance or carbon adaptation, issues a certain number of credits. That scheme is verified by a verification agent to ensure the baseline of carbon that would be emitted without the scheme, the carbon effect that scheme would have, and validates that each carbon offset is worth a certain amount of carbon reduction or mitigation effectively. Anybody can purchase these schemes. It's a voluntary initiative. Once you've used that credit, it is then retired. Anybody can set up a scheme. Effectively, it is a very, very flexible scheme. Most voluntary carbon markets are used to supplement compliance carbon markets as an additional means to offset carbon emissions.
Thank you so much, Eugene. Maybe moving to Ken then, to start with the slowing down, and if I can get other perspectives as well. What's your take on that?
Sure. I think first of all, the chips in on what Eugene mentioned. And first of all, bear with my voice. It's so sexy, but I think one thing we need to pay attention to is in the compliance market, like what Eugene mentioned, the overall credit issuance or the quota issuance should reduce over time because you need to attain certain reduction target. So it's a more like administrative way of doing so. Why there is a market? Because someone short of credit would love to get someone who have surplus, right? That's why there is a market. But one interesting point to raise is throughout this process, one, the overall price is expected to pick up, meaning if we measure from probably the market size perspective, I don't have the exact numbers, but from the overall market value, meaning number of credits times price, even though the number of credit issuance should drop, but the price should pick up. I cite an example. One is Europe, like EUA price pick up from probably last year 50-60 euro to this year 90-100. Second, Chinese emission allowance, the CEA, following the national scheme, not to mention the pilot scheme, the price pick up from 50-60 renminbi to 70-80 renminbi recently. So we need to pay attention to the price change as a result of potential reduction of the overall issuance size. I mean, the issuance size is a function of the aggressiveness and the NDC of the jurisdiction, and second, whether they can do it, reduce fast enough, right? So that's one point I want to make. The second point I would love to make is the linkage between the voluntary market and the compliance market. As Eugene rightly pointed out, that the voluntary market can serve as a function to make up the shortfall in compliance market. One good example is China, right? They have resumed CCR since last week, and there is a 5% linkage between the voluntary and the compliance. Of course, in mainland perspective, they take the voluntary market as a quasi-compliance market because it's more like tools for the MEE, right? So one thing that we need to pay attention to the linkage. The second form of linkage I would like to draw attention is the linkage between voluntary carbon market and the carbon tax regime. One good example is Singapore, right? Singapore allows a company within the radar of the government if they're heavy polluters like oil refinery and so on, that they need to pay a carbon tax, where the carbon tax can be deductible against the purchase and retirement of voluntary carbon credit. Of course, they have whitelist certain projects that they can achieve. What does that mean? I mean, to address what Helene mentioned, first, the overall size of voluntary market versus compliance market is still small, but the growth rate should be quick. That's one point. The second point is the slowdown of the SIGA in terms of the speed. There are a couple of factors. One is about some of the debates, market debates, over, for example, the additionality of certain methodology like REDD+ in terms of forestry conservation, whether or not they really do a role and play a role in terms of reducing emission or do good to the environment. So there's a heavy debate because there are problems in terms of baseline estimation and so on. The second one is the demand. One is supply, one is demand. So one is about the quality, integrity. The other one is demand. There are very rapidly changing macro environment, the war, right? There are wars, not war, around the globe. And that obviously that impacts on certain area like Europe in terms of the pace, but not the target of their overall decarbonization journey, right? So this add up, and I mean, the aggregate fact, I mean, result is there's a landslide in terms of price. There is a heavy and rigorous debates in terms of revising certain methodology, and that's why the Asian pace reduced. And there are a lot of discussion over in the market whether some of the standards, like what Eugène mentioned, like Vera or Gold, that they're going to apply for ICBC, MCCP compliant. Obviously, Gold standard is the first one, right? All this meaning they will take a break. I mean, my take is after that, probably the pace will go back a bit again from an issuance and trading perspective. But we don't expect too much on trading because by nature it's not a very tradable asset because it's not fungible. But the overall demand and issuance should pick up after all these facts. And second take is, I personally think the debates in the market is healthy, like law, like rules. It all undergoes years of debate so that we can come to a consensus among different interest parties and strike the balance between obviously environmental benefit and human being, right? So I think that's my 2 cents on that.
Hey, thank you so much, Ken. I think you actually point to, some of the reasons for the slowdown, but also, looking ahead, a more healthy pace of growth with all the different interventions like carbon tax and other things that are happening around the world. King, maybe some perspectives from the financial services as well as the FinTech angle that you are involved in?
Well, I think some of you may know that Invest Hong Kong is the inbound investment promotion agency of the government. So therefore, our main job is to invite and attract companies from around the world, including mainland China, to set up in Hong Kong. So therefore, we're looking at this, challenges or this big topic from an inbound promotion perspective. At the same time, if they do come, then whether or not these companies who are offering whatever services and products can make a living, right? Can they find the demand of those solutions and services? So this is how we look at things. Now, so in addressing this, the first thing that we did, which we have started probably Q1 this year, we're still in the final stage of finalizing that study, and that is to find out the companies from around the world that have a pretty smart pricing model and very smart business model. Now, I think the good example that a lot of us can more easily relate to, that we often like to use as that sort of like poster child, is the Tesla model. But I'm not talking about a car. I'm talking about the solar panels and also the batteries that they're selling in the US. Now, when you think about the sales pitch from Tesla to people trying to sell them solar panels, they've done a few things extremely smart, right? First, they market the tiles, the solar panels, just like tiles. And they look pretty stylish. Actually, I look at a few of them, look pretty stylish. So I won't mind putting on the top of my roof. Now, and secondly, they've been able to squeeze the price so much that incremental cost over the traditional tiles is not that much. Yeah, it's still more expensive, but it's marginal. Now, but more importantly, they also will look at the fact that will actually help you to do all the calculation in terms of payback period. So if I'm somebody owning a single family house, you install solar panels, and then yes, upfront is a bit more expensive, but then oh, by the way, they got the Tesla partners, they can offer financing. So I mean, as you know, the Americans like to finance everything. So, by having extra, 10, 20, $50 per month of financing it, it may not feel much, right, in the long run. So therefore, it's much more acceptable. Now, but then the nice thing about that is the next part of sales pitch is, oh, by the way, since you're going to have all these solar panels and you can store them in the battery and for the car and the Tesla car, the unused battery the energy can be fed back to the grid. You can sell back to the grid. I mean, the whole 9 yards. So essentially, after the payback period of say 3 years, then essentially the whole infrastructure, the CapEx is yours. So anything beyond is like you are making money from this investment that you are making, right? So I think it's a smart sales pitch, right? So if I'm somebody who has this, I guess, drive to do good to the world, I mean, this is great. But when it comes to having to fork out money to buy something that is serving like public good, I guess all else equal, there's only a small population that's willing to do that. Now, but then if we are able to find some solution or solution providers that are so smart in figuring out the pricing model, business model like Tesla, then in terms of driving adoption, I mean, it's not slam dunk, but definitely it's a bit easier. So this is how we approach it, by going through this study to find the companies like the Tesla, so that we are able to also identify the ones that are more applicable in Hong Kong. So we often like to use the fourth generation nuclear reactor as the example. Yes, it's great, right? And even Bill Gates is vouching for it. But I just can't see people buying a fourth generation nuclear reactor put in the backyard or put in the balcony. I just can't see that in Hong Kong. Now, so that's why technology like that may not be as easily adoptable in Hong Kong. So that's the exercise that we're going through. In a way, hopefully, we're able to bring some companies that can make money at the same time serve the climate change challenge.
Yeah, very interesting, King. I think it points to a lot of the kind of trade-off in a way between some incremental increase in price or whatever you have to pay, and also the benefits, whether to the environment or to sustainability as a whole. And I think one of the caveats here that might impact the carbon markets is the third-party assurance. Okay. Without third-party assurance, a kind of harmonization of global standards, it's very hard to get investors' confidence. There's a lot of arbitrage in terms of pricing and all that. Maybe Eugène, what have you heard from your clients on this?
Yeah, we've spoken to a number of very significant financial institutions about the inhibitors to them participating in voluntary carbon markets and what would entice them to do that. Now, there's many ways full service banks, for instance, can participate in carbon markets, and investing in credits or acting as market makers are just two of them, but they're maybe the most obvious that come to mind. Others could be, for instance, project finance of offset schemes, for instance, providing finance, bringing together third parties like consultancies, like verification agents to help them structure them. There's a whole host of things they can possibly do, but what particularly concerns them, I think, are two things. Firstly, the scalability of these markets. They're still, at least in Asia, relatively nascent and still relatively illiquid, which has all the pricing and exit and entry difficulties that are associated with any relatively illiquid financial market. Now, that may be a product of immaturity. It may change over time, but there are some catalysts that can deal with that. And I think the main catalyst is really ensuring a perception of the integrity of these markets. That's what's really lacking at the moment. Not to say that the markets lack integrity, but I think, very significant financial institutions are by nature quite risk averse. They're used to operating in a heavily regulated financial environment and on heavily regulated markets. And if one were to look at equities markets, for instance, and to a lesser degree, commodities markets, both of those markets are much more heavily regulated than the carbon markets effectively. Now, of course, we have to draw a distinction between compliance carbon markets and voluntary carbon markets. But for voluntary carbon markets, really, they're a private sector initiative at the moment. The regulation is through contract between the parties who deal on those exchanges. That may work perfectly well. There's nothing to say that it might not. And the other efforts to regulate them are efforts such as through voluntary market standard settings, such as the ICVCM, the Integrity Council for Voluntary Carbon Markets, that have just this year come out with their core compliance, core carbon principles for compliance for voluntary markets. I think the other thing is the question of, hardcore financial services regulation. Is this applicable to carbon markets? There are differing views on that. A carbon offset is not necessarily a financial instrument, but it has, the markets for them have certain characteristics in common and certain distinguishing features as well. IOSCO, the body that sets standards for financial services markets regulation, securities and commodities, has recently issued a paper on compliance carbon markets and is about to issue its paper on voluntary carbon markets. That will suggest, in a progressive and proportionate manner, as the markets evolve, the adoption of some principles of financial services market regulation. I think it's important to adopt a balance there, and this is something I sit on the Sustainable Finance Committee for ASIFMA. ASIFMA today just issued a paper upscaling voluntary carbon markets within Asia. It's available on their website if you're interested. And it says that, there are some principles from financial services regulation that would be applicable to the regulation of the verification agents, those that run the registries, ensuring market integrity, dealing with market surveillance, reporting to themselves, but maybe not publicly, large positions that are adopted within those markets that may be manipulative or suggest systemic issues, and also potential market crimes as well. So I think at the moment, that's one key thing. I think the other key thing is the links between markets. At the moment, there are a lot of voluntary carbon markets being set up in Asia. Some may fail, some may acquire scale just through the credibility of their own trading infrastructure and the success of them as a product standard setter and other things. But the question would be, can I take a voluntary carbon market offset credit from one market and trade it on another, for instance? Could I use that credit in a compliance carbon market? Now, there's difficulties with that because it potentially undermines the integrity of compliance carbon market in terms of there's a fixed number of offsets that are issued. But those issues of scalability, interoperability, and integrity are, I think, the key things that will enhance growth. I think the other thing is, large financial institutions in of themselves have they will provide liquidity, and B, they will enhance standardization and bring some of that integrity as well. So there's a sort of chicken and egg question there. Do they participate and help grow these markets and lend them credibility through their participation, or are they going to wait for the regulation and external bringing of credibility to these markets? I don't know the answer to that. It should really be a combination of both.
Hey, thank you so much, Eugene. I think a couple of major words I pick up there. Interoperability of that is hugely important for the agenda, and something that's still work in progress. We don't see that as yet. Okay. Secondly, like the core carbon principles and all those initiatives, being worked on to have some kind of parity, some form of parity among the markets, which is essential for carbon markets to truly take off in a way that probably can help the sustainability agenda. So on those, it touches upon a lot of regulatory, initiatives as well. Maybe Ken, you might have something to add to that.
Let me address a couple of things. The first point I want to raise is current market is quite interesting. Without a reference, obviously from intelligence, I think half of the credits are owned or traded by not more than 5 guys. Corporate, not financial institutions. Right? I mean, that's one. Second one is from a financial infrastructure perspective, because I think one point Eugene mentioned about the interoperability, it is quite interesting as well. From an exchange or platform perspective, like core, the credit is interoperable, is transferable by default. Why? Because almost no platform owns any credit, own any standard. No one. I.e., my credit sitting in one registry can move across with no doubt. In financial terms, there's non-deal transfer. It's very easy. I can transfer to Helene tomorrow by clicking a button on my phone. It's interoperable by default. So, but for jurisdictional scheme, unlike Vera or Gold, that one is more heavily regulated. So I think if we put into some context of the regulations, obviously I cannot comment, but I try to share my 2 cents from a personal perspective and nothing to do with Hong Kong EX. The first point is there are 2 things from a regulatory perspective that we're talking about them. We need to manage 2 things. One is about purely from a participant behavioral perspective, i.e., like stock market, people try to make some market, and if they manipulate the price, then that guy would be in trouble, right? That's something that we call the market surveillance, and all this that should or should not be managed. I don't have an answer to that for one good reason, because the market is not liquid. Right? Helene closed 10, Eugene closed 20, I closed 100, King's at 5, right? It's all possible within a day. Why? Because the product itself is not standardized anyway, right? And second one, Eugene pointed out a point is when you use it, you retire it. Meaning for certain vintage, certain project, assuming that project is liquid enough, the outstanding tradable credit will be reduced over time. So interesting that the liquidity by itself will reduce, but like red wine, then 2019 is not fungible with 2016, right? So it's not helpful. So this is the nature of carbon credit that that makes it very difficult or more challenges in terms of managing, especially from a pricing behavior, because most of the so-called quote-unquote manipulation in financial markets are about price and try to front run some information. Obviously, the second point is not concerning the first one, concerning the carbon, but the pricing could be, right? But that one is difficult. The other part is, other than the behavior, the other part is the product, i.e. the integrity of the product. Eugene touched base on core carbon principle that hopefully becoming the standard of the standard. But there are points I would love to raise from personal perspective. One is not the trouble. The question to be addressed is not just about for example, carbon credit quality or integrity. Even like ICV, CM, CCP, like the permanence they assume is 40 years for the fact that they just want to say, after 2060, none of my business, right? Almost, right? Is it good? Is it true? I don't know, right? Is there a way we're trying to make it more scientific? I don't know, but it could be important. So there are some assumptions that we need to bear in mind. The second one is, I mean, Eugene also raised one point that is very interesting about the compliance, the quota, right, by default. The way I take quota is probably is not aligned with Eugene's view, but my view is it is actually a carbon offset avoidance, not even removal, with an infinite time. So by default itself, it do not mean asking you control your behavior, do not reduce the carbon dioxide in the atmosphere. But what we need to do is both, right? One is to ask you to emit less. So that's why the market kicks in. The second one is the voluntary market can serve as a complement to the compliance market, because we hopefully sustain a project that can really remove the carbon dioxide. Of course, they have avoidance carbon offset from the atmosphere. But from a quota itself, I take it as avoidance credit, not even, but with a permanent nature. So whether or not the allowance market will have more integrity, I'm not sure. But probably the next phase from a regulatory perspective, and also from the product generation perspective, is not just about the generation of the credit itself, but also heavily impacting the demand right-hand side of the equation is the social perception, or if there is a social consensus in terms of carbon credit usage. Actually, this is one of the very heavy debate, not just ICVCM, but also right-hand side standing on the VCMI, right? That really triggers a lot of important questions on the overall development in the VCM, because we all not just say the financial, but from an environmental perspective, I tend to say ICVCM, VCMI could be the next.
Thank you so much for those insights. If those acronyms are a little bit too much for you, I'm sure we can, spell them all out again later. But I know there are quite a few questions from the floor. There are people dialing in online as well. So maybe if I could trouble Leanne to try to raise some of those questions. And please, in the room as well, if you have questions, feel free to chime in.
Hi, so there's even more acronyms right now. I think this question is directed towards Ken. In the compliance markets, or CEA, otherwise known as Compliance Emissions Allowances Market in China, will HKEX be able to provide or plan access to products based on the CEA market?
For now, we can't. But in the future, I don't know. But I mean, take a look at the allowance market itself. It's still very nascent. I think that the key things may not be like connectivity, but there are a long way for CEA market development. For example, inclusion of potentially 2 additional industry into the mandatory market. I think that is one of the focus for CEA development. The second one is like the data quality, which we are very aware of what the regulators is eyeing on, because the data quality directly impacting on the calculation of quota usage or surplus. I think those are the key before we probably take a look at the how do we say, assess, the question about the assess. I think that is still, I personally think is still a heavily regulated market.
Another question is, what sectors/types of corporations are embracing the VCMs now, and why?
I think that's a question that everybody can chime in. Kate and Eugène.
I'll leave that to Ken because he's running the market. But I mean, I think, those markets in particular that are under heavy pressure to decarbonize rapidly, so your oil and gas sectors, your agricultural sectors, things like that, the major greenhouse gas emitting sectors. Now, they vary by region and by economy. So, I mean, I'd be very interested in what you see, basically.
Actually, if I could just chime in here on one thing first, because this morning, just fresh off my mind, I was doing a mandatory training program for one of the stock exchanges in the region. And one of the industry that drives their GDP heavily is plantation, palm oil in particular. So, yes. And the reforestation, or how do you actually use, innovation in cropping to ensure that the deforestation can be, the damage can be minimized. So I think there are a lot of initiatives around that as well. So I just want to, bring that up when I still remember it.
That's a super interesting point. And I totally agree with what Eugène mentioned. The usage is actually very diverse, like what Eugène mentioned earlier about financial institution. Probably they are taking it as a product to serve the client, probably taking the product as a way to invest, taking position. But purely from like core, we have a very diversified portfolio. I just generalize it into several categories. The first one, like heavy polluters, obviously a key. The way they take VCM could be a way to offer proxy hedging to their existing business portfolio. The simple logic is when carbon price picks up, and normally like oil and gas price should comes off because demand should drop. So there is a good angle taking as not retiring the credit, but say holding or trying to develop projects as a way to proxy hedge the business. That's one. Second one is that is very common, supply chain related. For example, people like onshore mainland corporates selling parts to some of the multinational corporates. they need to reduce, and obviously urgently to reduce, like what Eugene mentioned. So they have to use different measures. They need to reduce by, for example, using renewable energy than conventional energy source. And obviously for unabatable, then they have to turn to the credit for the fact they might want to obtain certain recognition or labels in order to comply with some of the net zero pledge by the MNC. So that one is a key one. Third one, obviously there are companies that that they want to demonstrate the commitment to the environment. It could be listed mainly, I would guess, that they use it as a tool to help on the ESG reporting. I mean, even Hong Kong EX, we use offset for offsetting our emission from like travel. It's public. So I think there are also sectors like some of the like IT sector, they say carbon negative, and someone use offset for different reason. But generally, I would tend to say those are the key like sectors or reasons for using. I'm not sure.
Well, just want to add two more angles for the audience to consider. Now, first of all, sitting in Hong Kong, a lot of times we can't appreciate as much because obviously this is a service-based economy. But then if we go abroad and then we will see, for example, Australia, right? Australia is very heavy in mining. So you go around and you'll see, in fact, I've seen this visual that they have plotted the different green-related projects across the country. It's so densely populated. I was like, wow, that's impressive. So then I asked the person who created that visual and asked him, well, by the way, was it like central planning that the Australian government planned this out across the country? The answer was no. The answer was because there was just so much mining, manufacturing, cements, that people just saw the business opportunities and they picked different parts of Australia to create different kind of green projects. Now, so this is one example I just want to make is that I think beyond the service-based economy like Hong Kong, in places like the other study that I also saw discussed with some folks recently is that I think for those of you who follow the Hong Kong FinTech scene, oh, by the way, we got FinTech Week next week, in which we are going to promote the AI bit. Now, but the point I'm trying to make is when you look at some of the studies out there, they've been tracking the energy consumption and the carbon emission and so on across many sectors. And in fact, a lot of the sectors have been seeing the diminishing usage of energy, i.e. the emission of the carbon gas and so on. The only exception is IT, more specifically data centers, right? When people think about the ChatGPT, how much power that they need to run the models, this is just mind-boggling. So this is one area that some of the, for example, the Huawei, and they've been doing this R&D to figure out the next generation of cooling, the cooling technology to cool off, the data centers. And I've seen it. It's amazing. In a way, they submerge the whole server. You can just visualize it. They submerge the whole server in a big bucket of fluid. It's almost like jelly. But somehow it still works. And that jelly just cools off, the servers just enormously, i.e. reduce the energy consumption for cooling off the systems. So this is an amazing development that we also keep an eye on.
I think technology definitely helps so much, and that's why that intersection of green, fin, and tech is probably that sweet spot whereby we can explore actions that can actually drive this. And actually thinking about a report on the intersection of green, fin, and tech that GoImpact recently did, and thank you for the support as well from Invest Hong Kong. I think that's very, very interesting. Two key findings, apart from talent gap, which everybody talks about, okay? It cannot be addressed immediately. We're all working hard on it. GoImpact is working hard on it. But the second thing is that interoperability and cross-sector collaboration. Voluntary carbon markets also calls for cross-sector collaboration. It cannot just be one party or one entity that are able to drive that. So it's actually a very, very interesting times. We're almost like the regulator side is playing catch up. It's moving so fast. We need to catch up in terms of having more robust standards, more interoperable exchange and all that. It's we can't move fast enough, almost. Are there questions from the floor? Yes.
Thank you so much. If I can just explore a bit more into the technicalities, actually. I mean, I'm just trying to make sense of the, the compliance market and the, and the voluntary market. I think the compliance market is easy to understand because there's a pretty decent definition of the baselines, right? But when I look at the voluntary market, it's a bit hard actually, and that really relates to what you guys mentioned about, kind of the integrity part of it. Could you guys actually give us more about kind of how to set up the baseline for the, voluntary market? Maybe one example I could give. I mean, for example, on a personal basis, if I come to this event by FTR instead of getting a taxi, do I actually generate any carbon credit at all? I mean, just a example, but just want to get your sense out of that. Thank you.
I'll take it. The baseline, first of all, without taking a look at the baseline, can I get some water? sorry. Oh, appreciate it. Thank you. Without taking a look at the baseline, thanks for the question. What you're asking is about the additionality of the credit. What you mentioned, personally speaking, no way. Because there is a very solid definition for the voluntary carbon credit. Right, there are definitions in terms of permanence, leakage, additionality, and all this. Before I talk about baseline, right? That's one.
Thank you for joining us today, Ken, despite your...
I won't fall and faint on the stage. So, but there are, of course, schemes, like what you mentioned, acting as an incentive scheme, like PHCR, 普惠, to encourage people to do more on a personal basis. That's my second point. In terms of baseline, there are guidelines like CDM. Sorry about that. That give you the way to estimate the baseline. It's very rigorous. So the definition is the project has to have needs, because VCM by itself is a way of subsidy financially to keep the project sustainable. So back to your transportation example, you're affordable to take a taxi, a bus, or metro. So there is no financial additionality in that sense. That one is very straightforward. But of course, this point is the source of debate in the past year. With some of the project, whether or not there is additionality and how they establish the baseline. Thanks for that.
I think really you have to draw a distinction between the baseline that's set in a compliance carbon market. The question is, if you're buying a carbon offset in a voluntary market, what benefit from a carbon reduction perspective does that scheme you're effectively funding have? You will want to reduce the appearance of your emissions. You purchase a credit from a scheme or an offset from a scheme that is calculated to have an additionality in terms of removing a certain amount of carbon generation. Okay, that's what you're doing. The market itself does not have a baseline. A project will have an effect that is then unitized through the issue of carbon offsets that represent each offset representing a certain amount of the overall carbon impact of that particular scheme, and you are purchasing that offset to offset some of your own emissions in an accounting or a disclosure sense, effectively, if I can put it that way.
Thank you. Leanne, I think there are quite a few questions online as well.
Perhaps we could give Ken a little bit of a break with this question. So this question is for Eugène and King. However, it may be a little bit sensitive seeing HKEX is here. The question is, what should HKEX and Hong Kong be doing better to develop itself as a carbon trading center and with the mainland? And for Eugène, what do your clients want from Hong Kong?
Well, this is not representing Hong Kong government's view. This is just my market observation, okay? And no Hong Kong EX. Now, the short answer is, when we look at the carbon market, first of all of us know it's still nascent. Now, at the same time, personally, I'm a strong believer in market forces. And by that, what I'm referring to, yes, we got the crown jewel of Hong Kong EX taking a charge on creating a carbon trading platform. At the same time, you ask around, you probably have heard of, I don't know, 10 times, 100 times more people talking about another major trend, and that is the tokenization of real world assets. This is like a really, a hot topic, particularly this year. Now, and why I bring this up is because when you go to even places like China, okay, when China bans cryptocurrencies, it doesn't mean that it bans the good idea of tokenizing some real world assets for practical use. So therefore, a lot of the people in mainland China, that some of them I personally met in Shanghai, in Shenzhen, and so on, many of them are looking at the business of, so can they, for example, tokenize some carbon credits and then trade those tokenized assets, right, on the digital asset exchanges. Now, a lot of people are doing things like this. Now, so naturally, from our standpoint, we are looking at creating that platform, that infrastructure, if you will, because we know the standards may take some time to work out. In a way, Hong Kong is just one city. There's a lot of other countries, arguing on the standards and so on. That may take some time. But for us, we would like to lay the groundwork. So therefore, then we would talk to, for example, SFC and say, well, by the way, now tokenization of real world assets like tokenized carbon credits is coming. What's your view on that? Now, and then you talk to our colleagues at SFC, they'll tell you, well, by the way, SFC is under SFO, they only would regulate the securities. So how to treat tokenized carbon credit is not so clear, right? So there are things like this that we have to work out. Now, while at the same time, there are some people already, trying out these projects, which we encourage them. Because in doing so, that can create more traction in the commercial market. And if there's enough money to be made, our view is that will attract even more attention and more attention to the carbon world, which is a good thing. So again, we're still very early, but then we're taking a view of creating that platform, creating that infrastructure and ecosystem.
I think from a sort of market development perspective, what our clients traditionally see as Hong Kong's competitive advantage is intermediating capital between China and the rest of the world. That may be inbound capital into China to fund carbon reduction projects, or it may be Chinese capital going abroad to fund carbon reduction projects. And that's really what I think the financial markets and intermediaries in Hong Kong are looking for. HKEX to sort of leverage its product expertise and its trading expertise, the Hong Kong authorities to cooperate with mainland authorities to make these markets interoperable, to facilitate that advantage, because the sort of soft skills in Hong Kong are understanding of how to bring non-Chinese finance to China and vice versa. And that's really where the sort of, I think, the human employment occurs to generate, economic wealth for the citizens of Hong Kong and other people who come here to further their careers effectively. And this is where intermediaries essentially see Hong Kong's competitive advantage. Otherwise, Singapore has a very sophisticated green finance centre. No disrespect to anybody, but they are a well-known competitor. But Hong Kong's obvious advantage is its proximity to China, its familiarity with China, the industries in China, the issuers in China, the economic circumstances, the political and economic circumstances, the legal infrastructure, and at facilitating and structuring deals in respect of that. And, voluntary carbon credits, as Ken said, are a means of subsidizing carbon reduction projects. Effectively, it's another form of finance, essentially. It brings somebody together who has a need to reduce their carbon impact with somebody who is economically developing a project that has that effect. And this is, I think, where ultimately, investors in Hong Kong and intermediaries in Hong Kong develop from both the exchange and from the government.
Thank you so much, King and Eugene. I think that summarized quite a very effective lay of land across, the region where our respective strengths and area of focus can be. I think we probably got time to take a couple more questions, Leanne.
So, in the interest of time and summing up all the questions, where do you see the future of Hong Kong's carbon markets in terms of carbon tax and perhaps its compliance with China's CCER market, which is China Certified Emission Reduction Scheme?
A carbon levy is essential. So Hong Kong has to confront this. Many jurisdictions in the region have a carbon levy. They're probably set at levels that are frankly unrealistic at the moment and probably have to rise much higher. Because, the whole thing about ESG is about pricing externalities into the economic model to improve decision making. Because at the moment, the damage to the environment is not priced into the system. That's an economic flaw. Pricing signals through a carbon levy will drive. So I don't know where the government's policy is in that. I'm waiting to hear. Some of you know better than I do.
Well, on the tax side, there are some comments some discussion in LegCo is public about carbon tax. Day back July last year, I think. I can't remember exact figures, but if I remember correctly, that the comment was there might not be an immediate plan for that. However, let's not forget, actually, we're paying carbon tax now, right? Like your plastic bag is actually a quasi-carbon tax. Your organics waste processing is also a form of carbon tax. So we essentially, it's not very carbon, but it's a different form. That's how I take it. Now, to the second question is about CCR, right? I think the key there are two questions. One is asking about CEA, one is about CCR. So basically, more like the question like what we're gonna do with Chinese mainland market, right? So, but I think the CCR is quite special in the sense it's still a very early stage of the development. If you're aware that in the past 7 days, they have issued 3 sets of regulations. The first set is about the pilot rules for CCER, that they make quite some changes, like 19 and 20 changes. The second one is about the 4 methodologies, of which one very important, if I'm not reading it wrong, is whether or not there should be an additionality assessment. That one is actually quite interesting. That really go against what we discussed today, right? The third point is the first set of rules is yesterday. It comes out like 6 p.m. yesterday about the roles of different entities in CCER. The first one is the NCSC of the MBE will take care of the registry before there is a national one. The Beijing Green Exchange would take up the roles of trading and settlement before there is a national one. And the credit before 2017, if I remember correctly, would not be able to use to offset the compliance market 5%. So there are a lot of development. So that's why I think what I would say, I would comment is still a very early but very happening stage. to look into how we can contribute to the market. And back to and it's also interrelated to the previous question, like what Hong Kong and Hong Kong EX do. I will take it now. It depends on what is our objectives and goal, because let's not just look into carbon market, right? Because the overall thing is about the decarbonization journey, right? Carbon is really the last final stage of things, because we need some place for people to exchange the quota, some place to exchange different instruments so that people can acquire the tools they want to achieve the net zero pledge, for example. But there are a lot of things that we can eye on without, I mean, just Hong Kong EX. One is like tech, what King mentioned. There are different way or better way, opportunities that we can capture, right? That's one. Second one is, for example, anything we can do about the energy transition, like policy address. We have a heavy, at least one page, full page on that, right? So, and funds about green tech fund, I think King it's into it. And I think all this would be a combination of solutions in order to drive towards how we can work close and contribute to mainland.
Yeah, thank you so much, Ken. I think there's so much insights that we have gathered, in this very brief exchange. And thank you for the questions, both online as well as in person in the room. If we can just extract one final kind of tips, one or two final tips from each panelist about what you see. I mean, this is not the silver bullet, definitely, okay? There are no silver bullets. Things need to work interoperably and in conjunction. There aren't any silver bullets. But what are some of the lower hanging fruits that, in your mind, might help the decarbonization journey? Carbon markets is just one of the tools. It's really decarbonization that we are after. Any thoughts?
Training company owners on the need for decarbonization, because not everybody gets that. Big corporates do, but small corporates don't. Secondly, training relationship managers in corporate banking to have decarbonization conversations with their clients, and how a mixture of green financing or sustainability financing and carbon offsets can assist them in that process so that it's less painful to make the economic and production adjustments that are necessary.
Thank you. Training, absolutely. Ken?
I would say awareness, because also, of course, can be done via training. But of course, when we're in touch with different corporates, it's all reaction time, action and reaction time. How we can really quickly raise awareness, not just because there's a heavy rain out there like 2 weeks back. I remember what Helene shared. That was very massive, and it's very close to us from a living perspective. But let's not forget the environmental sustainability is also meaningful in a commercial sense. We can stop producing and then we have no emission, but that's not the case, right? So I think raising awareness in terms of commercial, how to strike a balance between environment and commercial is key, and to understand how net zero pledge to affect the business, because tomorrow you might lose your contract because of that. So I think awareness is really something in urgent.
Yeah, thank you so much. King.
Well, I guess the experts have talked about the areas that are the more low-hanging fruits. So perhaps I would just touch on something not so close, but then it's also a direction that we feel if we can do it right, Hong Kong can not only benefit ourselves, but also lead the region or even lead the world. And that is a project that we've been keeping an eye on called DPIN, Decentralized Physical Infrastructure Network. Now, this is a very new, well, I guess it's not a new concept. The US had it for some time. But then you think about what that is that just think about the greenwashing conversation. It's all about tracking. So that, can you imagine, okay, let's just say that we are able to find something that is a natural fit where the data can be more easily tracked. And then you start to think about, okay, what are the different sectors that in a way contribute more of the carbon emission? Then you would marry the two into, so what about there's this kind of decentralized blockchain in which on one hand, it is tracking the solar panel energy production. So that now, I guess now the whole world is shifting to smart grid, right? So in a way, we think about the next generation investments, it will be the smart grid, because I think the energy decentralized production of energy is no longer reliable as we continue to move forward. It'll be much more distributed energy generation anyway. Now, but then if people are able to sell the energy back to the grid, so now we are talking about more incentives to get the human beings some good, better reasons to do the right thing. I mean, the point I'm trying to repeat over and over again today is that, yes, we need to do our parts to save our planet. But this is almost like my son asking me, hey, Dad, you have to work out more and stay healthy. You have to do exercise, right? 3 times a week. Yeah, I know that's the right thing to do, but I just can't do it, right? This is against human psychology, right? Human behavior. So that's why we've been thinking about, okay, what are the things we should bet on, invest on, that is more aligned with human psychology? Not so hard to get the companies or the people to do the right thing. So once we're able to lay the infrastructure that plays to human psychology, then we have a better chance of doing the right thing with human incentives.
Thank you so much. So we need to work hard, but hopefully there are tools to help us make it a little bit more convenient. It's good. Thank you very much, everyone. And we hope to see you very soon in another series that we are collaborating with the FinTech Association. So thank you, Eugene. Thank you, Ken. And thank you, King.